Have you ever noticed how everyone claims they can time the market? Buy low, sell high sounds simple, right? But if you have ever actually tried to do it, you know it is almost impossible. The truth is, no one, not even the so-called experts, can predict the stock market with consistent accuracy. But there's a strategy that quietly beats all the chaos. A method that doesn't rely on luck, perfect timing, or wild guesses. It's called dollar cost averaging. And it might just be the most powerful investing strategy that ordinary investors can use to grow their wealth steadily and safely over time. So today, let's dive deep into why dollar cost averaging beats market timing, how it actually works, and how you can use it to build real long-term wealth. No stress, no panic, no crystal ball required. Let's start with the problem. Market timing. Every investor dreams of buying at the bottom and selling at the top. But here's the brutal truth that it's practically impossible to do that consistently. Even professionals with advanced analytics, AI tools, and decades of experience get it wrong. Because the stock market is not a straight line. It's a roller coaster full of unpredictable turns, emotional reactions, and global surprises that no one can see coming. Think about it. In 2020, no one saw a global pandemic coming. In 2022, no one predicted how inflation and interest rate hikes would shake the market. And even in 2023 and 2024, with all the data we had, no one could accurately call the exact highs and lows of the S&P 500 or crypto cycles. That's because timing the market isn't just about predicting prices, it's about predicting people. It's about guessing when millions of investors around the world will buy or sell. And that's something no algorithm or human brain can fully control. So if trying to time the market is a losing game, what is the smarter alternative? You guessed it, dollar cost averaging, or DCA. Now, what exactly is dollar cost averaging? It's an investing strategy where you invest a fixed amount of money at regular intervals, say every week or every month, regardless of whether the market is up or down. For example, let's say you invest $500 every month into a mutual fund or an index fund. Some months prices are high, so your $500 buys fewer shares. Other months, prices drop and your $500 buys more shares. Over time, this approach smooths out the ups and downs. You end up paying an average price for your investments. Not the highest, not the lowest, but a balanced middle that naturally reduces your risk. Here's the magic. You stop worrying about timing. You stop stressing over whether the market will crash tomorrow. You simply invest consistently and let time, not timing, work in your favor. Let's look at a real-world example. Imagine two friends, Alex and Jordan. Alex tries to time the market. He waits for the perfect moment to invest, reading headlines, following predictions, and trying to guess when the market will dip. Jordan, on the other hand, uses dollar cost averaging. Every month, no matter what the market is doing, Jordan invests $500 automatically. After 5 years, who do you think wins? Almost every study ever done on this topic says the same thing: Jordan wins. Why? Because while Alex is sitting on the sidelines waiting for the right time to buy, Jordan's money is already working. Even if Jordan bought some shares at a high point, the regular investments during low points help balance everything out. Meanwhile, Alex missed out on months or even years of potential growth, all because he was afraid to make the wrong move. Remember, time in the market beats timing the market. Here's another way to think about it. The stock market has bad days, bad months, and even bad years, but over decades, it's gone up more often than it's gone down. Since the 1950s, the S&P 500 has had a long-term average return of about 10% per year. So if you are constantly jumping in and out, trying to guess those ups and downs, you are likely missing the biggest growth days, which makes a huge difference. In fact, studies from JP Morgan and Fidelity have shown that if you missed just the 10 best days in the market over a 20-year period, your returns could drop by almost half. Miss the best 30 days and you might make almost nothing at all. And here's the crazy part. Those best days often come right after the worst ones. So if you panic and sell during a crash, you could miss the rebound that follows. That's exactly why dollar cost averaging works. It keeps you invested through the highs and the lows. But there is another reason DCA beats market timing. It helps you control your emotions. Investing isn't just about numbers. It's about psychology. When prices fall, fear takes over. When prices rise, greed takes over. These emotions push investors to do the exact opposite of what they should. Buy high, sell low. But with dollar cost averaging, you take emotion out of the equation. You're not making decisions based on fear or excitement. You're following a consistent plan. Your investments keep going automatically, even when your emotions are screaming stop. And that's how real wealth is built, through discipline, not drama. Let's do a simple illustration. Imagine the market goes like this over 4 months. Month 1, price is $100. Month 2, price drops to $50. Month 3, price jumps to $75. Month 4, price rises again to $100. If you invest $100 each month, here's what happens. Month 1, you buy 1 share at $100 divided by $100. Month 2, you buy 2 shares, $100 divided by $50. Month 3, you buy 1.33 shares, $100 divided by $75. Month 4, you buy 1 share, $100 divided by $100. Now you own 5.33 shares total. Your total investment equals $400. The current price is $100, so your investment is worth $533. You've made a profit even though the price ended at the same level it started. Why? Because you bought more shares when prices were low. That's the quiet power of DCA. Now, let's compare that to trying to time the market. Let's say you waited for the perfect moment and only invested once, maybe when prices hit $75. You'd buy 1.33 shares, worth $133 when prices hit $100. You spent $100, made $33. Not bad. But if you had been consistent with DCA, your returns would be higher, and you wouldn't have to guess anything. That's what makes DCA unbeatable for most people. It is simple, automatic, and psychologically easy to follow. But here's the thing. Dollar cost averaging doesn't mean you ignore the market forever. You still need to choose good investments. DCA works best with solid, long-term assets like index funds, ETFs, or blue-chip stocks. Things that grow with the economy over time. It's not magic, it's discipline combined with quality. And over time, that discipline compounds. Month after month, year after year, those small, consistent investments grow thanks to the power of compound interest. Einstein called compounding the eighth wonder of the world, because the longer you let your money grow, the faster it multiplies. That's why dollar cost averaging is such a powerful wealth-building habit, especially if you start early. You don't need a lot of money. You just need consistency and time. Let's put it all together. Market timing is like trying to win the lottery. You might get lucky once or twice, but in the long run, it is a losing game. Dollar cost averaging, on the other hand, is like planting a tree. You water it regularly, it grows slowly, and one day it is huge and unshakable. No stress, no guessing, just steady, reliable growth. So what is the takeaway? If you're serious about building wealth in 2025 and beyond, forget trying to outsmart the market. Forget chasing the perfect buy or sell moment. Start automating your investments. Set a fixed amount. Pick a strong index fund or exchange-traded fund. And let dollar cost averaging do its quiet, powerful magic. Because while everyone else is trying to guess the next crash or boom, you will already be building wealth, one consistent investment at a time. And that's the real secret of long-term investing success. So the next time someone tells you they are waiting for the right time to invest, just smile and say, the best time to invest was yesterday. The second best time is today. Because with dollar cost averaging, every day is the right time. If you found this video helpful, make sure to like, share, and subscribe for more powerful investing insights. And tell me in the comments, are you a DCA investor or do you still try to time the market? Let's see who is playing the long game.